So I have 5 plays for you. One is a home run and the other 4 are high return plays with a little lower risk. What's going on, option investors? My name's Henry. If you're new, I'm continuing a series on options because that's my area of expertise when I was working for Goldman Sachs. And in this video, I'm going to explain to you why I think it's time to buy leaps. What are leap options, why they are important, how they work, and the benefits, so make sure that you stick around. I'm gonna give you a few leap plays now that the market has sold off a lot as well. Before I jump in and flood your pockets with money, make sure that you smash that like button for Uncle Henry and subscribe to the dopest YouTube channel about option trading. So first of all, an option is an agreement between two people, and a leap is a long-term call option. Buying a leap call option is betting on a stock rising. So a call option is just a contract that allows the buyer to purchase 100 shares of stock at the call option's strike price. A leap is the same as buying a regular call option, except it's a further out in terms of its date, about 1 year or more. I've looked at leaps as around 9 months because they capture 2 to 3 earnings periods, which can make a stock move a lot. That's really the ultimate goal. You want to make sure that the stock moves up a lot so your leap call option can make you a lot of money. Now, the benefits of buying a leap option is it gives you a cheaper way to bet on a stock rising than having to fork up a lot of money to buy 100 shares of the same stock. A leap option still allows you to control 100 shares of a call option. Now, basically that call option is also going to be half off because the premium that you pay is way less than buying the 100 shares to begin with. Many option traders or viewers will tell you a leap is over 1 year out. I'm more concerned with the results rather than the definitions. I've worked with many investors in my Discord who during my coaching calls tell me that they lost money buying short-term call options. They try to buy them out of the money to make it cheaper. Now, that is a very big pitfall that many option investors make as a mistake. That's not the way that you want to invest with options. Instead of buying low probability out of the money call options that are expiring short-term, it is much better to buy something with a higher delta. Yes, you will pay more, but a higher delta means that the chances of the option expiring in the money is higher. Buying a leap option is even better because it's like owning a stock, but cheaper. I'll show you some examples and plays that I'm looking at right now. So I have 5 plays for you. One is a home run and the other 4 are high return plays with a little lower risk. First stock is NIO. NIO beat Q1 2022 revenue and EPS predictions. The firm's Q2 2022 delivery outlook disappointed, however. That's because supply chain issues and C-19 lockdowns still weigh on NIO's short-term production prospects. But look, here is my thesis and how you can make money with leaps. It is a very specific method. I believe the market is currently not prepared to value NIO based on its long-term potential in the electric vehicle industry. Growth companies like NIO need to convince investors that they can ramp up production and revenues fast. Otherwise, investors are not willing to pay a premium valuation factor. But in the long term, if they grow, it doesn't matter what the short-term investors do because the long-term money pouring into the stock will increase its price. For that reason, I am recommending leaps to certain investors for big upside returns. Here's the caveat though. You want to dollar cost average into these leap options. So let's take a look at NIO's options. We have a few different strikes that we can select, also a few different expirations. Now, for a proper leap option, I'm gonna go out for about a year. I may even go a little bit further. Actually, June 16 is exactly 1 year away from today. I could go for January 19, 2024, but I'm gonna show you a different Hail Mary play with another stock that I'm gonna cover in just a few minutes. And I'm gonna go a little bit longer for that stock. But for NIO, I'm gonna go for June 16. That's 1 year out, exactly a perfect leap option. It could be a little bit less than 12 months, even if it's 11 months. A leap option is basically a long-term option where you capture in a few quarters of earnings and a certain thesis that you have behind the stock. So for buying call option, now I'm going to look at the different strike prices. I want to make sure that I have a delta that is right around the money. So what that means is around 50. If I click into 17.5, this is probably going to give me 0.68. And then if I go to the 20 strike, the delta here is 0.62. That's pretty good. I want an option that is a little bit over 50%. That way, more than half of the time, this option is going to expire in the money. The break even here is $25. It's pretty high actually. So $5 is the premium here, $20 is the strike, and the break even is $25. The current share price is $18. So this stock does have to move up a significant amount by about 33% in the next year to break even. However, if the stock moves up by say 50%, so it goes from $18 per share to $27 per share, you're going to see a decent return on your investment. In fact, if it goes up to $27, you're going to have a $7 return. You're paying $5, so you're going to see about a 40% return. But if NIO hits $30 per share, that's where you'll actually see a double on your money in 1 year, because $30 minus the strike price is $10. Now you're only paying $5, so you can turn $5 into $10 in 1 year if NEO goes to $30 per share. I think there's a decent chance that that can happen. So this is a leap option on NEO. I would say this one is not a super safe play, but it is a high return play and it does have a decent amount of risk, but I think the overall risk is worth the reward. I would put a little bit of money into this position. I really wouldn't overdo it. I would potentially buy one leap option. Another good idea though, I mentioned dollar cost averaging. Basically, if you buy one call option right here at the 20 strike, or even if you do it at the 17.5 strike, in fact, looking at it right now, I think the 17.5 makes a lot more sense, because if you check out the break-even price right here is $23.80, which is a lot quicker where you can break even, and the premium is not that much more. So now that I think about it, I would not go for the 20 strike. The 17.5 looks a lot more attractive. And in fact, the 15 strike looks even more attractive. Obviously, you can keep going down and the price keeps decreasing. You can go for a 2.5 strike. Your break even is $19.03. At that point though, I do think you're overcooking it a little bit. I don't think there's a point to go down to 2.5. So you want to pick a little bit of a sweet spot here. The lower you go, I mean, you do have a higher delta. However, you do have to pay a lot more in premium upfront. And I want to reduce the upfront premium that I'm paying. And because this is a leap play where I'm not putting that much money to work, I don't really care to dump too much money into this. I just want to see if my view will play out here, and I want to put a little bit of money to work. In terms of putting more bigger money to work, I would probably do a covered call. I'd sell a put. I'd run the wheel strategy, which you can watch all of these type of videos in my description. I'm going to have a link for you with another video on YouTube. But for a leap play, you don't really want to invest too much, especially because the market is down right now. So say you don't have that much cash, this is a good play for you to just put in a few $100. That's why I would say I would go down to maybe 12.5, because the break even is 21.43. But more than that, you're starting to pay $1,000 in premium. And at that point, I would run the other strategies. So taking a look here, maybe 15 would make sense. And what I mean by dollar cost averaging as well is you can go for the 17.5. You can buy one call option here. You can buy another call option here at 15. Let's say that NEO pulls back and these both become cheaper. Now you can actually add to your position and dollar cost average into your leap plays. So there's a lot of very interesting stuff that you can do, but whatever you do here, you're basically going long NEO. If you believe in the stock, then buying any of these call options is going to be profitable. And by the way, you don't have to hold until expiration. A lot of people ask me, when do you actually close out a leap? You can hold this leap option for 3 months, for 6 months, for 9 months, and then you can get rid of it and actually take a profit before it enters that last 3 months, and especially that last month of really high theta or really high time decay, where the option is going to start losing a lot of its value. So instead of waiting until the very last day of expiration, I would typically hold the leap option for 6 to 9 months if it's a year out, and that way you can cut it out at that point and take a profit in a shorter amount of time. The next leap play is Palantir. Tech stocks have been absolutely crushed. It is time to sift through the rubble for uncut gems, and I believe Palantir continues to be a good value for a hyper growth story. Palantir once saw its stock trade for astronomically high levels due to hype regarding its artificial intelligence products and just due to hype on YouTube. The hype has since faded though, but Palantir remains a very compelling play on the growth of data and analytics. So I actually have a data analytics degree on top of my finance degree, and that's because I know data is going to be a very big part of our economy. That's how companies make better decisions. When I look at Palantir stock, it's not super profitable, but it generates free cash flow and has a very cash-rich balance sheet. Over the next 2 years, I expect the stock to double. We will look for a leap option that is going to capture in this longer-term perspective, and you're going to be shocked by how much money can potentially be made with Palantir. Here's Palantir's options. So I'm going to go down. I'm going to pick about 1 year out, but I'm actually going to look at January 19, 2024, because Palantir is a little bit more of a longer-term play. I mean, this company needs more time. You can't expect a company to deliver you crazy results in 3 months, 6 months, 9 months. Sometimes companies need a little bit more time to play out their story and to close more deals. For Palantir, it's closing more government contracts. And that does take time, right? Building relationships with the government and selling them for tens of millions of dollars doesn't happen overnight. It's really difficult to have someone even buy something for a few $1,000s, right? $5,000 or $10,000, yet alone millions of dollars. So January 19, 2024 is going to be better than a 1 year option. It's about a 1.5 years. I wish I can go for a 2025 option, but I just can't do that. This is the current available option on Robinhood for January 19, 2024. I would love to go for June 2024 or even January 2025, but we're going to work with January 19, 2024. And because I do think that this stock can go on its way to doubling up to about $15 per share, or even higher than that, let's say $16 per share, you'll see right here that the break even on the $5 call option is $9. So it's actually not that much. And even the break even on the $10 option is going to be a $12 break even. So if this stock goes up to say $15 per share, well, 15 minus 10, the strike is going to be $5. So you can turn $2 into $5, which is actually a 2.5x return. That's more than doubling your money in about a year and a half. Very attractive right there. Now for the $5 call option, if it goes to $15 per per share. That's a $10 return, and actually $4, 2.5 times also $10. So basically you're gonna get a 2.5x return either way, which is why I would probably go for the cheaper option right here. Only $200, so you're betting $200 today for a potential reward of about $500 a year and a half from now if the stock goes to $15 per share. Now, of course, this stock can go much higher. Let's say that it goes to $20 per share. Well, $20 minus 10 is going to be $10, so you can turn $2 into $10 or a 5x on your money. Turning this play into a 5x opportunity is like turning $1,000 into $5,000 or even $10,000 into $50,000. Now, I wouldn't put all my eggs in one basket. For me, a safe risk management play would be putting about 5% or less in one single play for a leap call option. So for a $10,000 portfolio, that would be about 2 or 3 of these leap call options. You can also do something very similar with Palantir. I do see it as a very big bargain, but if it ends up falling some more, then say you buy one leap call option right now. Well, if Palantir pulls back by, let's say, 50 cents or $1 and it goes down to $7, this premium is going to be cheaper. And then what you can do is you can actually buy a second leap call option. Let's say that it goes down from $2 down to $1. Now you can buy another leap call option, averaging your premium to a break even that's going to be much better than this $12.10. Because basically now, when you pay $1, now your break even is going to be better and your average premium paid is not $2, it's actually $1.50. Next play I have is on Block. Very important to understand its current position. Block is a true fintech disruptor that I've avoided for 6 months for good reason. I saved over 50% for myself and my Discord investors by not touching this name. This stock has been absolutely decimated in the last few months along with so many other innovative tech names. The stock has actually fallen a good 70% plus from its peak to its throw. That said, even with the horrific action in the stock market, the company is still growing sharply and it's moving more towards being profitable in a sustainable manner. It is my opinion that shares actually become reasonably valued when they dipped under $90 per share, but under $70 per share, I think there's a very big opportunity to own this disruptive name. The market cap is $35 billion. This company was trading for a 52-week high of $289. That is ridiculous to even think about. So it is absolutely a high potential. This stock can be at least $100 per share. So jumping into Robinhood, I want to show you what I would do with Block right now. That's going to be obviously another leap call option because this video is about buying leaps that are undervalued. So for Block, I'm going to go to trade Block options or Square, what they used to be called. So buy call option. And again, I'm going to go out for about 1 year into the future. And that's going to be June 16, 2023. So I'm going to look at a break even that's under 100 and all of these are under 100. In fact, I wouldn't be surprised if Square were to go to $120 per share if we saw a shift in the market and they started delivering some good earnings and interest rates were not going as high as a lot of investors in Wall Street think right now. But either way, even if it goes up to $100, your break even on a lot of these plays is under $100. So let's say that we pick the 65 strike price. I'm going to expand this right here. The bid is pretty decent in comparison to the ask. It's not as tight as I usually like it, but because this is a leap play that you're only going to buy once in a year, not really a big deal to lose 20, 30 bucks one time. The implied volatility is 77%. This is pretty high and the delta is about 62. So a 62% chance that this option will expire in the money. Again, this is pretty decent odds. This is really good odds, in fact. So if the stock goes up to $100 per share, that is going to be about a $35 return. You're paying $16. 16 times 2 is 32. So you're going to be more than doubling your money. You're going to more than double your money if Square goes to $100 in 1 year. That is going to be a significant move. But again, it doesn't have to go up to $100. In fact, Square can go up to, let's say, $70 or $80. If it goes up to $70 or $80 and that happens within 3 to 4 months, you can just cut this option. This option will likely be up from $16 to something like $22, $23, $24. And at that point, you can take a 50% return and just take your profits and go away. You can go into a different name that you like, or you can just reinvest into a different stock or a different leap option. But I think this is a really interesting play, especially because this stock has been decimated so hard. It is a very big disruptor in the market. So a $65 leap play would be really good. The $60 leap play would also be good in my opinion. Now, speaking of disruptive innovation, there is a company called OptionsFi, which my friend is building. And basically this software has beat the market 9 out of 10 years with an average yearly return of 35%. This software is a done-for-you software that's basically picking call credit spreads, covered calls, debit call spreads, debit put spreads, and 8 different strategies for you. It's using a machine learning and AI algorithm to basically scrape the option chain, figure out what is attractive to buy and sell, and then it gives you a daily recommendation for a weekly play. The link is in the description. My buddy also hired a financial analyst so you can get a portfolio review, and they have a newsletter that they send out about the stock market. The next stock that I want to talk about is PayPal. It's another interesting play. Over the last 12 months, PayPal has rapidly declined from its highest valuation since becoming an independent company in 2015 to its very lowest valuation. The company's products are some of the easiest, lowest cost avenues to transfer digital money to family members or merchants, and they continue to introduce crypto products. Bitcoin has fallen a lot, it's in the toilet, but it's likely to recover in a year. PayPal is a good growth at a reasonable price stock, so let's check out some of the options there as well. The interesting thing about PayPal is it has a September 15, 2023 expiration, which is just a little bit over a year. So I'm going to click into September. That's an interesting expiration to have. It also does diversify your overall leap exposure. So say all of your leaps are expiring June 2023. That's kind of okay, but another thing is June could be a particularly bad month. So I don't mind diversifying my expiration dates. And for PayPal, it has a September 15, so that is amazing. Now, if I scroll down here into the current share price, it's $73, and currently the 72.5 strike call option has a break even of $90. For PayPal, I wouldn't be surprised to see this stock also go back up to $100 per share, and this stock was trading for a 52-week high of $310. So let's just say it goes up to half its valuation of $150 or half of its peak. Well, that $150 is going to translate into about a $75 increase, and you're only paying about $17 or $18. Either way, this is actually a 3 or a 4 times or a 4x opportunity in PayPal, which is absolutely mind-boggling because most of the best investors in the world have an average return of 20 to 25%. So if you can double your money in a year or a year and a half, you're obviously going to get to financial freedom a lot quicker and grow your wealth rapidly. For PayPal, there's some competition. They have some risks. So again, I wouldn't invest more than 3, 4, or 5% of your money in this portfolio. And if you're actually going to be investing in Block or Square, then you don't want to have too much money in Block and PayPal because they are two very correlated assets because they're both fintech companies. So if you're going to do both, then I would put 2% of your portfolio in one and 2% in the other. If you're going to do one or the other, then maybe you can go 4 or 5%. Now, the last stock is really the Hail Mary play. This stock can make an absolute killing in terms of return. This stock was trading for a 52-week high of $29. This stock is Oatley, and I did cover Oatley in my Discord community. You can see the post right here that emerging oat dominance has really been high. I mean, it's really high in Sweden, it's high in United Kingdom, it's high in Germany, and it's actually growing really rapidly in the United States as well, and it's taking market share away from soy and other milk substitutes. Oat milk is a very rapidly growing industry. Now, I do have one issue with Oatley. It is not cash flow positive. I do like to look for cash flow positive companies, and it does have very bad financials at the moment, so it's hard to recommend, but I made this post on June 7th. Today is June 15th, and the stock has become a lot cheaper. In fact, over the past week, the stock is now down 9%. Under $4, I do think it becomes a lot more attractive. It was trading for around $4.50 just a week ago, and today it's at $3.82. So I really like this as a Hail Mary play because the oat industry is growing. Yes, this company isn't profitable, but in the next year, maybe year and a half, they can report a lot of good earnings. So I do want to take a look at some leap options because the leap options are going to be crazy profitable if this company goes in the right direction. So buying a call option January 19, 2024, the $5 call option is going for $1.53. That is pretty expensive. If you take into account $1.53 against the current stock price, this is almost a 40% premium. Very high price to pay. It's not a high dollar amount. It's only $153, but it is a high price to pay in comparison to the current stock's price. However, the company was trading for a 52-week high of $29. So say it has some really good earnings, and this stock isn't really held down with the market because this is a smaller cap company and is really dependent on actually its earnings and the market trend that it has in the oat industry and in the milk substitute industry. So this company can report some good earnings, some good news. It can even have a buyout, right? A bigger competitor can buy this company out. And if that happens, then this company can go up to $20 per share. And if it goes up to $20 per share, you're going to be laughing all the way to the bank. It's going to be a $15 return, 20 minus $5 of the strike price, $15, you're only paying $1.50. That is a 10x return. So you're going to be laughing all the way to the bank, but this is a more of a Hail Mary play. But if you want to see how I'm playing it, then make sure you check out the description for my Discord link where I'm actually going to be dollar cost averaging into leap options into Oatley over the next few weeks because I think this company could have a really big return. I'm going to keep researching it, updating my Discord community, and also do my best to keep you guys updated on YouTube as much as possible. Thanks for watching, and I'll see you in the next video.